Hello and welcome. In this video, we will learn about exiting the contract. Alright? Now, let us take an example. There is a buyer and there is a seller. And on April 10, 2023, they enter into a contract. Okay? And what is it? It is a Cipla April futures contract. So Cipla is an Indian pharmaceutical company, and the buyer buys April futures and the seller sells the April futures. Now they buy, or this person buys, or this person sells one lot. Okay, and lot size is 650, which means one lot contains 650 stocks of Cipla. And at the time of entering the contract, the price is 960 rupees. Okay, at the time of entering the contract on April 10th, the price is 960 rupees, and the expiry is April 27, 2023, the last Thursday of the month. Now you may have a question: why does it need, or why there is a need of expiry? Why do we want an expiry date? Well, that is how a futures contract works, correct? The buyer cannot just buy a Cipla April futures contract and then keep it with him forever, correct? He cannot do that. He can do it with stocks. He can buy stocks of Cipla and he can wait 10-20 years, all right, for the price to go up. But this is not like that. He cannot just buy Cipla futures and keep quiet. There has to be an end to the contract, correct? And that is why we have expiry. The seller cannot just sell the futures and keep quiet. There has to be an end before which he has to do whatever he has promised. Okay, and as you know, the contract is just a promise. Nothing is exchanged between buyer and seller. Okay, so it is just a contract. All right, it is just a contract. Now there are many things that the buyer or the seller can do with the future contract, but let us take three cases. Okay, now before we look at that, just remember that the buyer can buy the futures on any date. Okay, he can buy it on 10th, he can buy it on 11th or 12th or 13th of April or 23rd of April or 15th of April or 21st of April, on any date before 27th. Okay, April 27th. But as the day is nearer to the expiry, the requirement of margin will be more. Okay, and generally people do not buy it near the expiry. Okay, so let us not go in detail to that. It is not a rule that if you buy it on 10th, you have to wait till expiry. No, you can buy it on 10th and sell it on 10th itself if you are in profit. All right. Now, let us see the things that the buyer and the seller can do with the futures that they have bought or sold. First is square off his position. Okay, the buyer can square off his position or seller can square off his position. Now what is squaring off? We'll see that. Now see, they have entered into a contract on April 10, 2023, correct? Buyer has bought the contract. Buyer has bought the contract on April 10th. Seller has sold the contract on April 10th. Now let us say that on April 11th, next day, buyer is in profit. So buyer can exit the trade by selling the contract. So buyer has had bought the contract, correct? And by selling it on April 11th, he can exit the contract. And this type of exiting is called as squaring off. Okay? If the buyer buys the future, he has to sell it. And when he sells it, it is called as squaring off. Same goes to the seller. If seller has sold the contract on April 10th, to exit it on the next day, 10th, then he has to buy back the contract. And buying back the contract is called as squaring off. Okay. So let us say that on April 10th they enter the contract, and on April 11th buyer is in profit, seller is in loss. So since buyer is in profit, he decides to exit that trade, and we say that he has squared off his position on April 11th. And since seller is in loss and he decides not to proceed further, he decides to buy it back, and that is called as squaring off. Okay. Now, the person who has bought the futures is said to have gone long. Okay. We do not say buyer has bought the contract. Okay. That is normal English, but in technical terms, in stock market terms, we say a person has gone long. A person has gone long. So when someone says that a person has gone long, then you must know that it is the buyer of the future. Okay. So going long means you are expecting the price to go up. Okay. So a buyer who has gone long, meaning he had bought futures, squares off his position if in profit or loss. So this is how we say it in technical terms. Okay. A buyer who has gone long squares off means exits the contract if in profit or loss. Similarly, seller is the person who has gone short. So going short means selling. Going short means you are expecting the price to go down. So when someone says that a person has gone short, you must know that the person has sold the futures. Okay. So seller who has gone short squares off his position if in profit or loss. Squaring off means exiting the trade. How does the seller exit the trade? By buying it back. How does the buyer exit the trade? By selling it. Okay. So this is one thing that the buyer or the seller can do on any day after buying the contract and before expiry. Okay. The next thing that they can do is roll over to the next month. Okay. Now let us say that the buyer and the seller enter into a contract on April 10th. Okay. Buyer has gone long, seller has gone short, and by now you must know that buyer has bought the futures, seller has sold the futures. So on April 10th they have entered into April futures contract. Now it is April 25th, near the expiry, which is on 27th. But they do not want to end their contract. So what can they do? They can exit the near month futures and enter the next month futures simultaneously. Okay? Meaning buyer has April month futures, correct? So he has to sell the April month futures and buy May month futures simultaneously. So he has to sell April's, selling meaning selling the one that he has bought. Okay, so he has bought April month futures, correct? So he has to sell the one that he has right now and then enter into a new contract. Okay, the seller also has to do the same thing. Seller has sold April futures contract, correct, initially. Now he has to buy back the April futures contract and then sell May futures contract simultaneously. The current month futures is called as near month futures and the next month futures is called as next month futures. You know that, right? Correct? You know that. Now that is what they have to do. They have to roll over to the next month. And while rolling over to the next month, they have to pay the difference amount in the futures price. So here you can see April futures is 920, May futures 924. This way there will be a difference between the price. And how is this price calculated? I have explained the formula, correct? So the time value here is more, and so this is bit costly than this, or this is on the higher side of this. Okay. Now time value is more here, and so this price is higher than this. So you know how to calculate this, or you know the logic behind this. No need to calculate it. You know how this works, correct? So they have to pay the difference amount and roll over to the next month. And if still they do not want to exit the contract by the end of May, they can roll over to the next month. Buyer can sell the May futures contract and buy June futures. Seller can buy May futures contract and sell June futures. And they can keep on doing this as many times as they want. Okay, so this is the second thing that they can do. Finally, on the date of expiry, there are two possibilities. Okay, let us say that buyer has bought or had bought April futures on 10th April. Seller had sold April futures on April 10th. Let us say that the buyer has forgotten about the futures that he has bought. Seller has forgotten about the April futures that he has sold. Let us say that they have forgotten about it. So they do not do anything as they do not know about it. And it is April 27th, the expiry date. If they do not do anything, then the broker will square off their position and settle the cash. Okay? If they do not take any action before the expiry, then the broker will take action on behalf of them. So buyer may be in profit or loss, seller may be in profit or loss. According to their profit or loss, it will be squared off. Okay? If the buyer is in loss, then the money will be taken from the margin. If he is in profit, the profit will be credited to the account. Same goes here. If the seller is in profit, the money will be credited to his account. If he is in loss, it will be taken from the margin. Okay, so that is one case. Another is the buyer or the seller can choose for delivery, meaning they exercise their obligation. What is it? The buyer had entered into a contract, correct, to buy 650 shares. And seller had entered into a contract to sell 650 shares. So if they choose for delivery, then on April 27, the date of expiry, the buyer has to buy 650 stocks of Cipla by paying the full amount. Okay. Now what had the buyer done till now? He had bought one lot of Cipla futures by paying just the margin money. Correct? Now, for any reasons, if the buyer wishes to go for physical delivery, then he will have to pay the full amount and buy the 650 stocks. Why 650 stocks? Because one lot has 650 stocks or shares. Alright. Now what is this full amount? Full amount is 650 into 1000 rupees. Okay. 650 is, full amount is 650 into 1000 rupees. Now what is this 1000 rupees? This 1000 rupees is settlement price. Now what is settlement price? Settlement price is the price of the future on the day of expiry and on the day's close. Meaning, in India, the market closes at 3:30 p.m. The price of the future at 3:30 p.m. on 27th April is settlement price. See, the buyer and the seller entered into the contract on April 10th when the price of the future was 960 rupees. The price has moved up and down since then, and on the date of expiry 27 at 3:30 p.m. market close, this is the price of the future. This price is called as settlement price. Okay, so 1000 rupees into 650 rupees, 650 shares. So this will be the total amount, full amount. This much has to be paid by the buyer and he has to buy the 650 stocks. Alright? Yes. The opposite goes for the seller. Seller has to sell 650 stocks of Cipla. So he will be needed to have 650 stocks or shares in his demat account. Okay. So he needs to have 650 shares in his account, which he needs to sell at this rate. Okay, this rate. All right. Yes. Now, see, retail traders do not opt for physical delivery. Only 1 or 2% of the traders may go for physical delivery. Rest everyone will either close their position 1 week before the expiry or roll over to the next month. Okay. Now, as you near to the expiry, let us say you are the buyer, as you near to the expiry, the broker will start asking for more margin. Because see, you need to pay the full amount, correct? How much is full amount? This into this. So the broker will start asking you to add money so that this much amount is accumulated in the account so that you can buy it on the date of delivery. So generally what you have to do is you have to exit your position 1 week before the expiry. Okay. Yes. Now this is about stock futures. You know that there are index futures too, correct? We have Nifty futures, Bank Nifty futures, Fin Nifty futures. All these are index futures. Now index futures are settled in cash on the expiry. Okay. Let us say you have bought one Nifty futures, one lot of Nifty futures, and let us say I have sold one lot of Nifty futures. Okay. Now we cannot pay full amount and buy the Nifty itself. This is a company, Cipla is a company. Nifty is not a company, it is an index. We cannot buy index. So there is nothing like paying full amount and buying the stocks, because Nifty is not stocks. So the index futures are cash settled, meaning upon expiry, if the buyer is in profit, he will get that amount in his account. If the seller is in profit, he will get that amount in his account. Alright. So only stock futures are physically delivered. Alright. So I hope the concept of delivery is clear. So that's it for this video. I'll see you in a different video. Till then, take care and thank you for watching.